We've had lots of calls about this, the next company out of the U.S. Bill's in Collingwood. Hi there, Bill.
Hi, good evening. I'd like to get David's opinion on Metropolitan Life as a long-term hold, and secondly, whether or not he thinks that that's a good purchase or whether I should stay with the Canadian insurers. Thank you very much. I'll hang up and listen.
Thanks, Bill.
Well, Bill, certainly, when you look at the insurers, one of the key questions is, do you think rates are going higher? Do you think rates are going lower? Certainly, higher long-term rates are good for the insurance companies. So they tend to work in a pack. Second thing about the insurers are many of them are focused in the wealth management side of things. Certainly the Canadian ones are, like Manulife and Sun Life. MetLife is in that camp as well. I think probably if you had to pick a direction, rates probably work their way a little higher as we go through the rest of this cycle. But that being said, I don't expect to get a huge tailwind from that. Our focus in financials has been more specifically in pure asset managers. We've talked about CI Financial as being one. There's some other investment counseling companies we've been invested in. So that would be my first choice. We think that you get really great quality out of something like a Sun Life, whose wealth management business is really doing well. MetLife, you probably get an industry return. You've got a 2+% yield. You get a little dividend growth. Financials are our second biggest weight, and we do have some insurance exposure. So I think you do okay. It's just not probably the best performing insurance company, but as far as they go, you'll do okay here.
And you're in Sun Life for clients?
We own Sun Life, we own some Manulife.
Okay. Fred's in Stratford, Ontario with the next question. Go ahead, Fred.
Gentlemen, hi David. My question is on Mullen Group. It seems like to be a sleeper and hasn't participated that much in the upsurge in the energy services stocks, and it's about to break a resistance line that's about 4 or 5 months old, I believe. I was wondering what's your opinion about it, and also on the side question, I was wondering why the barrier of entry to your firm is so high. If it wasn't that high, I would be camping in front of your office tomorrow. Maybe should be about 1/10 of what it is now. Thank you very much.
Well, Fred, thanks very much. Now, just on that, about 40% of our business comes directly to us, but about 40% of our business is through financial advisors, so certainly their minimums, I think, are quite different than where we are in our direct business. So I'd encourage you to talk to an advisor. On Mullen Group, this is in the right group. The services companies, are doing particularly well. Mullen, really isn't so much a sleeper. It's behaving better than about 70% of stocks in the S&P over the last 12 months. So relative strength is not so bad. So you've got tailwind from the sector. You've got tailwind from the equity asset class itself. Mullen is a very steady performer. So I don't see any major catalysts in the near term, but it should perform in line with the group. You're unlikely to get any big surprises, positive or negative. So I think that this is a good longer-term investment and one I would be happy having. We aren't invested in the stock currently.
What would you compare it directly to, this company?
There are so many companies that are in the services and logistics business. They are unique in their business. They've got a great business in the transport and logistics. It's one that I think that I'd be very comfortable owning.
Mm-hmm. Okay, on to gold now. Neil is in Toronto. Good evening.
Hey guys, how are you?
Good. How are you?
Thanks, Neil.
Good. Dave, I want to ask you your thoughts on Agnico Eagle. It's actually starting to outperform and lead gold in terms of performance, and that's usually a good sign. I wanted to see if you guys are starting to look at the golds again. Thanks.
Right. So for people who have watched over the last 18 months or so, we've been particularly bearish on gold. I think it is getting to a point where it's been pretty sold out. Certainly a lot of the stocks are extended to the downside. And there's two things that can happen here. One, if we are in a longer-term downtrend for gold, which we believe we probably are, it doesn't mean you can't have great trading rallies. And certainly the sector's been really sold out, and it looks like there's a little trading bounce setting up here. I'm not convinced it's more than a couple of month rally. It could turn into more than that. So what do you want to do? You want to look at the best performing stocks in the group. And certainly Agnico is acting better. It's based out over the last year. We have one small position on. We've got some DSG, and it looks okay. But
you mean Detour?
Yes, Detour, sorry. DGC.
DGC, yeah.
So we'll see. We'll see. Seasonally is when you should start to see a little more strength as you go through summer. We start with a little bit. We put our stop in. If they start to work, we'll look at adding some more. But I think this is probably more of a trade than a longer-term theme.
Let's look at Detour because it's still the best performing stock in Toronto this year, up again today. What is it about that story that you like?
Well, there's a whole bunch of things about this one that we like, but obviously there's some significant growth attached. We think it could be a target over time here. From a price perspective, it is the best performing stock in the group. It's nowhere near the lows. You know, when you see a group start to bottom out, there will always be a couple that take off first. This stock was $3, it's trading at 12. You know, it's quadrupled basically.
Yep.
At a time when the junior and mid-sized golds are hitting new lows every day. So we've taken out, you know, some reasonably significant highs today. Stock's had a great day, lots of volume. Technically, it sets up well. It's one I think that you could take a look at for a trade.
Detour Gold back in 2011 was nearly a $40 stock. Corey's in Vancouver with the next question here. Go ahead, Corey.
Oh, hello, Mr. Burrows. Is BorgWarner a strong global industrial? I'm looking at it for some continued growth since the dividend is poor. Thank you.
So outside of energy, financials, and technology, industrials really are about the best group in the market. I think that what we're doing is we've positioned ourselves in industrials that will benefit from just slightly improving economic growth. I think it's highly unlikely we get a recession anytime soon. There's no extra capacity, there's no extra inventory. You know, BorgWarner gets about 25% of its sales from the U.S. We are focused on companies that get more exposure to the U.S. About 50% of the revenue is coming from Europe. This is one that you can own. It's got good exposure to auto. Our companies in the auto group are Lear, Magna, and Linamar. But this company is behaving very well. It's got a relative strength of about 87, meaning it's behaving better than 87% of the stocks in the S&P so far this year. So it's the right group, strong company, good earnings. Revenue is picking up last 4 quarters to up 2%, up 7%, up 13%. So you're seeing acceleration in revenues, which is something we like to see.
And just before we take a break for past picks here, I'm curious how open-minded you are to the stories that are pretty well daily that you can find on the internet and elsewhere about this market and that it's overbought and we're due for a terrible correction and things like that. And all the internals are pointing in the wrong direction.
So here, this is the hardest kind of market for people to stay invested in. In the 1990s, earnings multiples expanded in 8 out of 10 years. So if earnings go up and the multiple investors pay goes up, you get a geometric lift in price. So earnings are growing slowly, but for the first time last year, earnings multiples expanded. The hardest market to invest in is one where the multiple is expanding because you can't point to where that value is coming from. So it's very confusing for investors. The thing is, when PEs start to expand, they can expand for years. So we believe we're in a new secular bull market for stocks, which means equities relative to other asset classes become more and more expensive. So yes, it's more expensive, the market, than it was 3 years ago, but earnings are growing, company balance sheets are in great shape, and your alternative fixed income at 2.5% yield is not very attractive. So we think that the pain trade is that the market quietly works its way higher. There's a lot of cash stranded, and what looks expensive today could be a lot more expensive tomorrow.
All right, and that's what it's been doing. And it seems like some people, they may be right at some point, but some people seem to be, they want to be right, and they want to be out there on record to see what I said back a year ago, I was right. Anyway, we'll see. We will take a break here and get to those past picks after this.